Option trading is a very risky business. It doesn't matter what kind of strategy you use. For example, I ended up losing $12,000 a couple years ago on some Tesla call debit spreads that I thought was going to make me $70,000. I didn't think about the $12,000 that I could have lost.
You just did not think this through.
It was the Battery Day event from 2020, and my $12,000 ended up going to zero. So options trading is not an easy way to get rich quick. Easy as it seems to turn your $12,000 into $70,000, you can still lose that $12,000 that you put down. So it's not an easy way to get rich quick, and it's going to take you years in order to learn, but hopefully that's not too discouraging for y'all and you are in this for the long term, because options trading can be a really good way to manage a portfolio of stocks that you already own. It can be used to hedge in case you think that there's going to be a market downturn. If you think there's going to be a lot of volatility around Biden dropping out right now, this can be a good way to make profits even when the stock market is falling. And then again, it can be a good way to manage a portfolio of stocks for many different kind of scenarios. With spread options that we're going to be talking about today, it's really good for trading around earnings reports and trading around big events because it reduces your implied volatility or vega exposure. So this can be a good way to not lose a ton of money if the stock doesn't make as big of a move as the markets expect. Here are the lessons that we're going to go over today. The Greeks, we already went over that in the last lecture from last week, but we'll go into more detail there. We'll go over implied volatility, what it actually means, and how you can kind of avoid IV crush around earnings reports when implied volatility drops, because the stock either does make a huge move or doesn't make a huge move. Then we'll talk about vertical spreads and how you can use these strategies in order to mitigate that IV crush that we just talked about after an earnings drop.
Wow, that's interesting.
And then we'll talk about the involved risks with vertical spreads and finalize this with some actual examples using Thinkorswim. Here are the learning outcomes for our lecture today. So hopefully by the end of the lecture, you'll be able to apply your understanding of the Greeks to choose the best option strategy for you, whether it be a call debit spread or a put credit spread. You'll be able to understand how implied volatility works in order to avoid overpaying for an option. So instead of buying a call option, if implied volatility is too high, you might end up buying a call debit spread instead. Then you'll have an awareness of the risks that are involved with trading options of these kinds to avoid costly financial mistakes like me losing $12,000 on the battery event a couple years ago with Tesla. And then hopefully by the end of this lecture, you'll be able to actually apply the knowledge that you learn from it in order to trade real world stocks for yourself. Because at the end of the day, real world experience with trading is worth a lot more than what you'll get out of this lecture and all the videos that I made. This is how I ended up learning, by actually performing. I initially started learning through the trading fraternity, where I would listen to his live streams every single day. But it wasn't until I actually started putting trades in myself when I actually started to learn this. And then now I'm teaching it to y'all.
That's good. It's really good.
How do Greeks impact the pricing of your options? Options pricing changes based on many factors, including implied volatility, like we just talked about with earnings reports. If there's an earnings report that's coming up and you buy a call option ahead of time and the stock still trades flat, but the implied volatility goes up, you can still make money. So then you have volume. If there's more demand in volume for an option, then implied volatility increases, which increases the price of the option. But most of this is really driven by the Greeks. So here are the Greeks: delta, gamma, theta, vega, rho. Delta is the change in the options premium for every $1 change in the stock price. So if you have a 0.2 delta, then your option will gain a total of $20 every dollar the stock goes up, and will lose $20 for every dollar the stock goes down. Then gamma affects your delta, since it is the change that the delta sees for every $1 change in the stock price. So let's say that you have a 0.05 gamma, and then that 0.2 delta we talked about, and the stock drops $1, then your delta will go from 0.2 to 0.15 to where now, if the stock goes up by $1, your option will only gain $15 as opposed to $20 before. And then if the stock goes up by $1 from that 0.2 delta with 0.05 gamma, then your new delta value will be 0.25. That's delta and gamma for you. Then you have theta, which is the value by which an option decreases for every passing day. This includes both holidays and weekends. It doesn't matter. Theta does not care about weekends. It will eat your lunch money if you're a buyer, and it's a good thing for sellers and people that have credit spreads. Then you have vega, which is the change in the options premium for every 1% move in the implied volatility. So let's say that your implied volatility for the option starts at 50 and then ends up climbing to 58, and you have a 0.05 vega. So you would multiply that 0.05 by the 8% change in vega. So now your option would be 40 cents higher because of vega value. And if the stock is trading flat and we mitigate all the theta decay, your option would gain a total of $40. Then you have rho, which nobody really cares about because this is a change in the options premium for every 1% change in the federal funds rate. And usually the Federal Reserve isn't changing interest rates too much unless you talk about the last few years. That's been pretty interesting, but usually people don't really pay attention to the rho. So those are the 5 Greeks. And all of these Greeks are dynamic, and they can change dramatically between the time that you open an option and the time that you close an option or the expiration date. The delta will increase as an option becomes further in the money. So if you're buying a call option, the delta will increase as the stock price goes up. And if you're buying a put option, the delta will increase as the stock price goes down and your put option becomes deeper in the money. And then your delta will decrease as an option becomes deeper out of the money. So with a call option, if the stock starts to plummet, then your delta value will decrease. And then if the stock starts to go up, your delta value for the call option would increase. But for a put option, your delta would decrease as the stock goes up and that put option becomes steeper out of the money. Then you have gamma. Gamma increases as an option becomes at the money, where the current stock price is equal to the strike price that you chose. And as the option's expiration date approaches, the gamma will increase as well. Sometimes this will actually offset the loss that you get from theta, which will increase as the option's expiration date approaches, and will also increase as the option becomes at the money. Interesting to note, the curve for theta is actually a negative exponential for at the money options. So as the expiration date approaches for an at the money option, theta will increase. But for in the money and out of the money options, it's more of a linear line for theta, right? And then we have vega, which will increase as an option becomes at the money again, where the stock price and the strike price are equal. And this will decrease as the option's expiration date approaches, which is the opposite to what happens with gamma, right? So gamma increases at the money, and as the option's expiration date approaches, it'll increase. But with vega, as the option expiration approaches, vega will actually decrease because implied volatility actually usually goes up towards the end of an option's life cycle. So in order to, I guess, not make millions of % returns, you have to decrease the vega value. And then you have rho, generally stagnant, but has a greater impact on higher price stocks. Implied volatility is basically the market's expected move or the implied move for the option itself that is based on the expectations for the underlying stock. So if there's a big move that's expected because there's an earnings report or a big reveal like robotaxis coming out, then there's going to be more demand for options, which increases the expected move based on all the options that are getting bought. And whenever the expected move is higher, so will the options pricing. So this will affect both call options and put options alike. If there's a big event coming up, like an earnings report, then all of the options are going to have a higher premium than if there wasn't that earnings report coming up. And this is why you'll often pay more for an option around big events and earnings reports, and why most people end up losing money trading earnings, because if the realized move is less than the expected move or the implied move from the market, then both call options and put options will lose value based on what's known as IV crush. So let's say the market's expect a 10% move, but the actual move after the earnings report is only 5%, both call options and put options will lose money. So let's say that it goes up 5%, you still won't make money on those call options because it didn't make the move that the markets expected and it didn't meet the implied volatility expectations. In order to mitigate this, we can use what are known as vertical spreads. So how do vertical spreads work? Vertical spreads mitigate IV exposure by simultaneously buying an option and selling an option with the same option type. So you would be buying a call option, selling a call option with the same expiration date, but with separate strike prices. So same expiration date, same option type, but separate strike prices. And credit spreads is where the trader is paid their max profit as a credit initially in exchange for putting up collateral that is equal to the difference between the strike prices multiplied by 100. So let's say that I have a difference in strike prices of $5. I end up getting paid 75 cents in credit in order to open my option. My max profit would be that 75 cents or $75 in credit, and then my max loss will be the difference between the strike prices, $5, minus the 75 cents for $4.25. $425 would be my max loss for that trade. So your max loss is limited to the difference between the collateral that you put up for the trade minus the credit that you receive for opening the credit spread if both options expire in the money. So the ultimate goal here, as somebody who is trading a credit spread, is for both of your options to expire out of the money. That way you collect the full credit that you got upon opening the trade. And then with debit spreads, it's the opposite. The trader will pay somebody in order to open their options. So they pay a premium to the counterparty, which limits their max loss to only the premium paid. So if I only pay $80 for $2 spread, so let's say the difference between my strike prices is $2, I pay 80 cents in order to open it. My max profit would be $2 minus 80 cents or $1.20, and then my max loss will be that 80 cents that I put up, or $80. Max profit 120, max loss 80. And your ultimate goal is to have both of the options expire in the money. That way you collect the difference between the strike prices minus the debit that you pay in order to open it. So this limits their profits to the difference between those. The difference between strike prices minus the debit paid. So that's kind of the problem whenever it comes to spread options. It's a good way to limit the amount of money that you're putting down. But it also limits the amount of money that you can make if your trade goes correctly. With credit spread, you can only make the credit. With debit spreads, you can only make the difference between strike prices minus the debit. So let's say that the stock ends up going up 50%, but you thought that it would only go up 5%. Then all you can make as somebody that bought a call debit spread is that the difference between your strike prices minus the debit paid. Whereas if you just bought a regular call option, you could have made probably 5-10 times more. So that is the drawback whenever it comes to debits and credit spreads. But it does limit the amount of capital that you need. So let's talk about call credit spreads versus call debit spreads. A call credit spread is similar to selling a call option, but you don't need 100 shares of a stock in order to trade it. So you don't need nearly as much capital. And the way the strategy works is that the trader will sell a call option at a strike price they believe the stock will be below upon the expiration date. So if I think that a stock is going to be below 110 on my expiration date, I'm going to sell that 110 call, and then I'm going to buy a call option with a higher strike price. So let's say that I end up going with a 115 call that I buy. I sold that 110 call. So the difference between my strike price is $5. That is my collateral, $500. And then I would receive a credit upon opening this trade. Let's say that I get 75 cents. My max profit would be $75. My max loss would be the $5 difference between the strike prices minus the 75 cents for a max loss of $425. Right, so that is the call credit spread. And then the call debit spread is the opposite, to where it's similar to buying a call option, but usually it's a lot cheaper. Let's say that the difference between my strike prices is $1 and I only pay 5 cents in order to open the option. So my max loss will be $5. My max profit, if both options expire in the money, will be $95. So you will sell a call option at a strike price you think the stock will be above, or let's say that I sell a 101 call. I'm assuming that the stock will be above 101, and then I'm going to actually buy, this should say buy, a call option with a lower strike price. So I would buy a 100 call, and I would pay that $5 debit upon opening the trade for a max profit of $95. So that was the call side, and now let's talk about put credit spreads and put debit spreads. Put credit spread is similar to selling a put option, but you don't need 100 times the strike price in order to open it. So let's say that I want to use a put credit spread for Tesla stock because I think the stock is magically going to go up by the expiration date. I don't have enough money to buy 100 shares of Tesla trading at what, 240 or what dollars? That's $24,000. So I can use a put credit spread instead by selling a put option at a strike price I think the stock will be above on my expiration date. So let's say that I think the stock is going to stay above $200. I'm going to sell a 200 put, and then I'm going to buy a put option with a lower strike price. So let's say that I end up buying a 195. Then my collateral is $500. 200 minus 195 multiplied by 100. And I'm going to receive a credit for opening that trade. Let's say that my credit is $120. My max profit is at $120 in credit. My max loss will be the $500 collateral minus the 120 for a max loss of $380 if Tesla is below 195 on my expiration date. So that is the put credit spread, and then the put debit spread is the opposite here, where it's similar to buying a put option, but you don't need nearly as much capital. So if I think that Tesla stock is going to go down over the next year, but I can't afford a leaped put option for it because it's going to cost me tens of thousands of dollars, I can use a put debit spread instead. So you will start out by selling a put option at a strike price you think the stock will be below by your expiration date. So let's say that I think that Tesla stock is going to fall all the way down to $100 by the end of next year. Crazy, I know. But if it does, I would make a large amount of profit because nobody is expecting that, right? So I would sell a $100 put option. That's the strike price I think it'll be below by the expiration date. And then I would buy, this should say buy a call option with a higher strike price. So I would sell that 100 put and then buy a 105. Difference between my strike prices is $5. Let's say that I only pay $50 in order to open this option, or 50 cents. My max loss would be that $50. My max profit would be the $5 difference in collateral, and then subtracting the 50 cents that I paid, for a max profit of $450 if Tesla is below $100 by next year. Really good trade. 10x profit, but obviously this is just hypothetical. We'll go over some real examples at the end here. All right, so let's talk about the risks that are involved, because yes, it is a good way to bring down the amount of capital that you need to open a trade, but there's still some pretty significant risks that we should be aware of. So debit spread buyers can lose 100% of their investment. Like me putting $12,000 into call debit spreads on Tesla a couple of years ago for their battery event, I ended up losing that full $12,000 because the options expired out of the money. So you can lose 100% of the investment that you put into it if both of your options expire out of the money. And then credit spread sellers can actually lose more than 100%. Let's say that you have an option that you sold initially, a credit spread that you sold for 25 cents or $25 in credit, but your collateral is $500. That means that you can lose $475 even though your max profit is 25. So technically your loss would be 19 times what you could win, or about a 1900% loss. The risk reward on credit spreads usually doesn't make sense, but the odds are usually further in your favor than using debit spreads. Debit spread buyers and credit spread sellers both face the risk of the option that they sold being assigned to them on or before the expiration date, but this can be easily mitigated by exercising the option that you buy. So this is very simple to mitigate the risk. Just exercise the option that you bought, and then it will counterbalance the option that you sold getting assigned to you. But both parties also face what's known as pin risk, where the stock may land between the strike prices upon the expiration date, which will actually force you to buy or sell 100 shares of a stock that you might not be able to actually afford. And this is when you'll get margin called. And a couple years ago, there was somebody that actually ran into this and ended up unaliving himself jumping in front of a train. So very important to consider the risks and not lose your life over this. That is the end, and here's our summary of vertical spreads and what we talked about. Vertical spreads, like other option strategies, are a very risky business meant as a tool in order to manage your portfolio and should only make up a small percentage of your net worth in order to protect your capital from stock market fluctuations. Don't put up $12,000 like I did, which was 30% of my net worth on that Tesla trade, to where I ended up losing 30% of my net worth in like a week. They can be used as a way to mitigate your risk of IV crush around earnings reports and major events, as they reduce your overall vega exposure. Since you're buying one option and selling an option, you balance out the vega a little bit, and you have a set max profit or max loss scenario based on the strike prices that you choose and the credit or debit that you pay. So this is really good for managing risks, since you have a set max loss, but again, you don't want to hold your options into the expiration date and then face pin risk, where you actually have to buy or sell 100 shares that you can't afford. And if you're new to options, these strategies might seem a bit advanced, but over time, you will continue to learn, hopefully, how to use different strategies for different market scenarios. And while these strategies may net huge returns for you over time, they often come with major risks, which should be managed carefully as to not lose more than you are comfortable or actually able to lose. So I've already got a semiconductor name already pulled up on the chart here. So right now, TSM is dropping after their earnings report. So again, this was a beat on their earnings per share and their revenue and their guidance, but the stock is still falling 30% or so. Or no, 15%, I think. Yeah, 15% drop in just a few days after the earnings report, even though it was really good. But let's say that I think that TSM is going to come below $150 within the next 6 months. Right now we're in July, so my expiration date will be out to December, I guess. And if I think that it's going to be below 150, right now it's trading at 165, I would use a put debit spread. And the way this works on Thinkorswim is I would, let me get rid of this on the left side. Right click, buy, and then vertical. All right, so it's going to automatically buy the 155 put and then sell the 150 put. So again, if it's below 150, the strike price that I sold, then I make the max profit here, which will be equal to the difference between my strike prices, $5, right? 155 minus 150 is $5, minus the debit that I'm paying in order to open the trade, which is 190 here. So my max profit would be $310. And then my max loss will be $190 or the debit that I pay in order to open this trade. But let's say that I think short term that we're going to get a bounce on TSM over the next few weeks because maybe it's just an overreaction to their earnings report. And I think the stock is going to stay above 155. These are just examples, not my actual thought process, so something to keep in mind. But I'm going to set my expiration date to 3 weeks out. Actually, let's just go with an August 16th expiration just because it's a monthly. There's going to be more liquidity with monthly options, which is really important when it comes to spread options because you're buying and selling two separate options, and that makes it a little bit more difficult to get in and out of your trade. So I think the stock is going to stay above $155. I'm going to right click this and I would sell vertical, and I'm going to get paid $124. That is my max profit. And then my max loss is equal to the difference between my strike prices, 155 minus 150, which is $5, minus that 124 in credit. So my max loss for this trade would be $376 if TSM is below my 150 strike price that I bought. But if it's above the 155 strike price that I sold, then I get to keep that full $124 in credit because both of these options would be out of the money and have zero value. So that is the put side. Now let's talk about the call side with a different stock. So somebody mentioned SOXS and SOXL. So SOXS, this is actually one of the ETFs that I've been buying. Actually not SOXS, but a different one, SSG. So this is another ultra short leveraged semiconductor ETF, but SOXX trading at $24.70 right now. Let's say that I think it's going to go above $30 because the semiconductor industry is probably going to have a hard time if we go into a recession next year. I'm going to set my expiration date out to next year, maybe in June of 2025 if they have it. They have January 2026. We'll go with February of 2025. And I think the stock is going to be above $30 by my expiration date. Again, these are just examples, not my actual thought process, but let's say that I think it's going to be above 30. What I would do on the call side here is I would right click, buy vertical, and automatically it's going to buy the 29 strike price and sell the 30 strike price. And I'm paying a debit of 103 for this, which doesn't make sense. I'm paying more of a debit than the difference between the strike prices, so maybe this isn't a good example. Let's say that I think Nvidia is going to rocket up over the next year, go up another 100%. Let's do something more reasonable. Let's say that I think it's going to go above 150 sometime next year, maybe in the middle of next year. I'm going to set my expiration date for June, and if I think it's going to be above 150, I'm going to go to the call side, and then buy vertical, and it actually bought the 150, sold the 151. We're going to change that though. So we're going to go with the 149, 150 strike price. And we're only paying 28 cents in order to open this option. That is our max loss, $28. And then our max profit will be equal to the difference between the strike prices, which is $1 minus the 28 cents. So our max profit would be limited to $72 if Nvidia is above 150. But let's say that we bought the 150 call, and somehow Nvidia actually manages to go up another 100% from where it's trading right now at $120. This will show off how a call debit spread limits your profits compared to just a regular call option. I would have to pay $1,500, which obviously is very expensive in order to buy this, right? My break even would be 150 plus the $14.95 for break even of 164.95. But if it's trading at 200, then I'm going to make $3,500 in profit from this trade, whereas my max profit was limited to just $72 from that 150, 149 call debit spread. But let's say that we're a little bit more reasonable and we think that Nvidia is going to come down shortly after their earnings report, which is coming out on August 24th, if I remember right. Let's say that we think it's going to trade flat or come down, actually. So right now it's trading at 120-ish, but I don't think the stock is going to go up more than 10% from here. That would be 110 or 120 times 10, 1.1, which would be about $130 or $132 or so. So I would set my expiration date for after the event. I think it was, I might have the date wrong on that. Let's just go with the August 30th expiration date though. And I think it's going to be below 130. Right now it's trading at 120. I'm going to sell a vertical. So I would be selling the 130 call option, buying the 131. I'm going to get paid 35 cents in credit. That is my max profit. All I can make is that $35. But then my max loss will be the difference between my strike price is $1 minus the 35 cents, which would be a max loss of $65 if Nvidia is above 131 on my expiration date. But if it's below 130, then I get my max profit of $35. And that's the call credit spread for you. We talked about call debit spreads, put credit spreads, and put debit spreads. So now hopefully you can approach earnings and not get killed by Ivy Crush. And if you found this video useful at all, make sure to like and subscribe for more, and I'll catch you in the next one.